morning, investors. Dire and ET now. Thank you for joining us. This show is nearly 4 years old, which means we have spent the last 200 weeks helping you get richer. On this show, we find all of the best investment products in the market. We line them up and design a portfolio for you. Let's get started. We have plenty of questions to answer this week. Over the next half hour, if you're young and you want to be rich, we'll tell you how to turn your monthly savings into big bucks. In our product review this week, we look at the ICICI Prudential Focused Blue Chip Equity Fund and find out how NRIs can lock in their savings in India and take advantage of the better interest rates. It's time for me to bring in Dhirendra, the CEO of Value Research and our in-house mutual fund expert who joins us on the show every week. Dhirendra, thank you so much for joining us.
Thank you.
Let's get straight to our portfolio question. Well, KISHORE has written in. He's 24 years old, Dhirendra. He has a monthly saving of about 21,000 rupees. Now, he has sent us a list of all of his investments. He has a term cover of 50 lakhs. He tells us his health cover is taken care of by his employer, 30,000 rupees in an emergency fund, and a contribution of 1,000 rupees into the PPF. He has a goal to accumulate a corpus of 1 crore rupees in the next 13 to 15 years. He hasn't told us what he needs that money for. He's also sent us a list of his mutual fund investments. He has Franklin India Blue Chip, HDFC Top 200, Quantum Long-Term Equity, HDFC Tax Saver. He wants to know if his portfolio is on track. Now, for someone this young, he seems to have everything in place. I'm only slightly concerned about our extra PPF contribution. And when you look at his mutual fund investments, are you impressed with what you see?
Well, I'm very impressed. And also, more than the mutual fund portfolio, I am impressed by his inclination to save and the quantum of his savings. The amount he's able to save from his income is quite outstanding. So if he's able to retain this focus, he is bound to, retire wealthy anyway.
Well, Dhirendra, let's take a look at his individual investments right now. He seems to be covered as far as insurance is concerned. There's a very handsome emergency fund as well. Between his equity allocation and his PPF allocation, would you like to make any changes there?
Maybe, he just got initiated to this PPF and he doesn't require the PPF given his, and 1,000 rupees is also a very meaningless amount in relation to his overall savings. And given that he has 30,000 rupees of emergency fund lying in a liquid fund accessible at 2 days notice. And he is able to save, 2/3 of his income, which is quite significant. He has chosen 3-4 good funds. And if he sticks to his plans, my understanding is that, he's young, he's getting started, so he's able to save so much. That may not be the case in future. But surely his income will also rise, it will go up. So if he's able to maintain this focus and keep it manageable like this, of course he can do without the PPF. The 4 funds he has chosen are excellent funds. He should just stay focused on saving as much and choosing funds with, good performance history, which he has done, and not get perturbed by, short-term underperformance.
All right, Krishna, Dhirendra, they're giving you 2 thumbs up for your entire portfolio. The important thing is that you continue to save at the same level. And of course, listeners, you don't need that PPF contribution, but other than that, you seem to be on track. Now, as part of our segment where we answer a question from one of our female viewers every week, this week we're answering a question from Revati. Dhirendra, she's a 45-year-old working woman. She tells us she's been investing 2,000 rupees every month in the HDFC Prudence, DSP BlackRock Balanced, FT India Balanced Fund and Reliance Regular Savings Balanced. Now, she has an investment horizon of 3 years and she wants to know if she should be choosing the growth option or the dividend option for this investment. What would you recommend she does?
Tax-wise, it is more efficient because balanced fund, they will be treated as equity investment because they invest over 65% into equity. All your gains for investments held for over 1 year will be entirely tax-free. And so, it makes eminent sense to accumulate through the growth option, not even consider the dividend distribution, the dividend reinvestment plan also because, there is a possibility that the direct tax code comes into play, and in direct tax code there is a provision that dividend from equity fund may also be taxed. 3-year time frame and balanced fund may not be the finest way, finest allocation because 3-year time frame may not be, might translate into a disappointing return. If it is a non-negotiable goal, then I would suggest that be out of equity altogether for a 3-year time frame, and you definitely need the money and you can't really withstand any decline in value. So consider a dynamic bond fund or a short-term bond fund which will be more appropriate.
Dhirendra, between a dynamic bond fund and a short-term bond fund, would you be able to give her a couple of names that she can use right now?
Of the dynamic bond fund, if I have to recommend some, I would say Templeton India Income Opportunity, or the SBI Dynamic Bond Fund and the Birla Sun Life Dynamic Bond Fund. Choose two of these three. Short-term bond fund, the IDFC or the Sundaram short-term bond fund, or the UTI short-term bond fund. They have been relatively superior performing with reasonable expense.
There you have it. The funds that Dhirendra has recommended are on your screen right now. We hope that helps. Remember, you can write back to us. And for the rest of our female viewers, we have a portion of the show set aside specifically for you. So make sure you write into us with any question you have about your money. Dhirendra, we have a question from Samuel George, who's written in. He's a senior citizen. He's looking for a tax-efficient financial strategy for him and his wife. Now, he wants to know if he can achieve a zero tax outgo, if he invests all of his money, so 20 lakhs in a fixed deposit in his name and 20 lakhs in a fixed deposit in his wife's name to meet their daily expenses. Remaining 40 lakh rupees, he wants to know if he can spread it across mutual funds and stocks and maybe bring in some liquid funds. He also wants to know if he can bring down his tax outgo. Will that exempt him from having to file his tax returns? Let's start from the beginning. Investing 20 lakh rupees each in bank fixed deposits, to save tax and also to handle their daily expenses, is that a good idea?
If you have no other income, because the tax brackets are well defined, and if income from all your sources fall within that, then you can escape tax or you are not liable to pay taxes. The other way of looking, and he's approaching it just the right way, because two things, two kind of income in this country is tax-free. One is agricultural income, which he will not have, and the other is gains from shares or equity funds. So, if it's investing in stocks and if they are held for over 1 year, and periodically if he is able to derive his, realize part of the gains, and that can well compensate for the decline in value of the deposits which he is making, and also to protect the worth of his capital so that in future he is able to, the decline in value of his capital which is producing the income, that can well be compensated by his investment in shares. So he has got it right, and this might be a very appropriate way for his limited goals.
Well, the remaining 40 lakh rupees, he doesn't seem to have a very coherent plan for it. He wants to spread it across liquid funds, across shares, across mutual funds. Would you be able to give him a little more structure for the rest of that money?
I would say that, that needs to be really approached very systematically, because though it is a long-term money, he does not require income from that. But he will require to, periodically realize part of the gains from that portfolio. And that is why that should also be, little conservatively managed. Having a conservative allocation, I would suggest that, he should choose 2-3 balanced funds. Look at our, stable growth portfolio. And that money should ideally be anchored around that. One, it will not go down in value substantially if the market, collapses at some point, which it can, we witnessed it in 2008, and it can happen again at some point, or there is a prolonged weakness in the market. The other is that, it will be tax efficient. His goal of realizing the gains in a tax-free manner will be achieved. And periodically, and if on a 3-year cycle he is able to, realize a part of the gains, that can well compensate for the decline in value of his principal, which is producing income.
All right, Samuel, we hope that helps. Remember, you can write back to us if you need any more help. We're going to take a very quick break. On the other side, Dhirendra will stay with us. We'll talk about the ICICI Prudential Focus Blue Chip Fund. Find out if you should be adding it to your portfolio now. Don't go anywhere. Thank you for staying with us. You're watching Investors Guide on ET Now. It's time for us to review our Fund of the Week. This week, we're looking at the ICICI Prudential Focused Blue Chip Equity. Avan is here to give us an introduction. Avan.
Thanks for that, Ray. Well, the ICICI Prudential Focused Blue Chip Equity Fund was launched in 2008 when the markets across the world were facing a meltdown. Despite being around for only 4 years, this fund has had a stellar track record. The fund faltered initially, but in 2009, it delivered its best performance, giving its investors a return of 93%. Its strategy is to invest in large cap companies from the top 200 stocks of the equity universe, but also limits risk for investors. Close to 60% of the fund's portfolio comprises of Nifty stocks. It concentrates on sectors like financials, energy and technology. The fund stays away from stocks which are heavily leveraged, which would explain why real estate and construction never featured in this portfolio. Let's do some math to give you a better perspective. If you invested 1,000 rupees in this fund when it launched, you would have 5,556 rupees today. So should this fund be a part of your portfolio? Our experts are here to give you the answer. With that, it's back to you, Faye.
Thanks, Avan. Dhirendra, ICICI Prudential focused blue chip equity. If we look at its performance over the last 1 year, when the market was very volatile, it's actually managed to do what you normally recommend, which is it's fallen less than the market in the last 3 odd months. It's performed better over the last 1 year. So is this the fund that we should be looking to if we want to avoid volatility?
Yes, it's a large cap fund. It's a focused fund. It can be a little more volatile than other large cap funds, but relative to the market, it has been reasonably stable. It has yet to complete its 5 years, but the first 3 years has been outstanding. It was able to beat other large cap funds and the index by a wide margin. It was among the best performing large cap funds in its first 3 years, almost consecutively. So it's an impressive fund. Of late, it is showing some weakness. There has been a fund manager change as well about 2 years back, but it remains a very impressive fund, a very tightly defined mandate, and it has shown the style purity. It has maintained its discipline.
All right, Dhirendra, give us our rating for the ICICI Prudential Focused Blue Chip Fund. Where would you place it?
Going by how it has done overall, the larger part and its design, I would give it a 4-star rating based on, factoring in the near-term weakness as well, much higher than the risk-adjusted performance rating that we see on our website.
4 stars there for the ICICI Prudential Focused Blue Chip Fund on Investors Guide. Let's move on now to our hold or sell segment. Well, Rajiv has written in, he wants to save for his daughter, Dhirendra. He plans to have 50 lakh rupees in the kitty in the next 13 years for her education. He wants 1.5 crore rupees for her wedding, which he hopes will happen in the next 20 years. He wants to know if his portfolio is on track. First on his list is the Franklin India Blue Chip Fund, 8,000 rupees a month. Continue investing?
Yes, an outstanding large cap fund, and he should continue with that.
Well, HDFC Equity is next on his list. I know you're very impressed with this fund as well. Continue investing?
Yes, he should continue investing despite the fact that, last 2 years has been disappointing. This fund shows its conviction and has amply, sustained it. So, and given his time frame, he has reason to believe it, so should continue.
So the next on his list is the IDFC Premier Equity. He's putting a little less into this fund, about 5,000 rupees every month. It's a very impressive fund, Dhirendra. Continue that investment as well?
Yeah, continue that investment as well, and and it's not insignificant. If you look at the total investment and 5,000, so it's little over about 7-8%. So that's fine, and this fund is a very impressive fund.
The ICICI Prudential Focused Blue Chip Equity is the next on his list. You just gave this fund 4 stars. He's investing 5,000 rupees a month. Continue investing?
Yes, should continue investing. This remains another impressive fund.
The next on his list is the UTI Opportunities Fund, Dhirendra, 7,000 rupees a month. Continue investing in this one as well?
Yes, this fund has, been a remarkably impressive fund over the past 3-4 years. And so, yes, UTI Opportunity, it remains a 5-star fund, should continue investing as well.
The last 3 funds on his list I'm going to take together. He has the HDFC Midcap Opportunities, HDFC Prudence, and HDFC Top 200. He has about 13,500 rupees going into these funds altogether. I'm reminding you again that we did already approve HDFC Equity in his portfolio. Obviously, there's a lot of overlap here. What would you like him to do with all of these funds?
I would think that, he can do without all these funds. HDFC Prudence doesn't fit here. Likewise, HDFC Top 200 and HDFC Equity will have a massive overlap. I would think that, he should consider only HDFC Equity and, maybe invest disproportionately. He should invest 15 or 18,000 rupees, which will be a substantial amount, little over a third of his investment, but he will achieve all the goals. And maybe he should, 15,000 rupees in HDFC Equity and 5,000 rupees in HDFC Midcap Opportunity. there will be an overlap there too, but he can look at it and he will eliminate the other 3 funds which he has.
Alright, Rajiv, Dhirendra has made just one small change in your portfolio. The rest of it seems to be on track. Good luck to you and your daughter for the future. So we have time for one more question. Prakash has written in, he's also retired, Dhirendra. He tells us he has enough money for his day-to-day expenses over the next 2 years, but after that he's going to have to start dipping into his savings. He has 1 crore rupees saved right now. Now, he does tell us that he will need about 50,000 rupees every month for his expenses. He wants to factor in a 7% inflation into that amount over the next 20 years. Dhirendra, what would you like him to do with that 1 crore rupees so it can pay him 50,000 rupees a month?
The appropriate allocation, assuming he requires the income from tomorrow, will be about 50% into fixed income so that he doesn't have to worry about the regular income, and 50% into equity in a conservative way, or and invested over a period of time, not to be invested at one go, so that he is able to prepare for protecting the worth of his capital and can take care of the inflation efficiently. And that could be very efficiently and in a very simplified way achieved with a balanced fund. One important tactical thing which he has to do is a person like him who has accumulated his savings and has to get into equity in a conservative manner must ensure that all these investments are not at one go. Spread his investment over the next 15, 18, 20 months, this accumulation over a period of time into high quality balanced fund. The kind of situation he is right now, in next 2 years time with the investment in balanced fund, he might have some appreciation, and periodically he should keep putting that money aside which he needs for consumption, and that will keep him, keep anxiety away, because he won't have to worry about what happens tomorrow.
Alright, so this is what you have to do. Split your money between equity and debt. Dhirendra is saying that you put the money that's set aside for equity into a balanced fund, and every time you see that money go up a little bit because the market has moved up, you move that money, you move the incremental returns into your debt investment. Dhirendra, as far as his fixed income investment is concerned, is a fixed deposit the best way to go?
Yeah, fixed deposit to the extent that it will be not taxable. And if he has no other source of income, the fine planning of this will require, his special situation, his other incomes. So he should certainly consult his, tax advisor and, some financial planner. But yes, broadly, these are the key principles. Reduce his taxes, derive the income in a form that is not liable for taxes, have his allocation right, and make sure that the money which you need for immediate consumption is there in your bank account, and you don't have to worry about things which your consumption requirement for the next 12 months at any point.
And as far as his balanced funds are concerned, would you recommend our stable growth portfolio to him then?
Yes, funds from our stable growth portfolio are the finest, are the best funds from the balanced fund category.
Alright, Prakash, we hope that helps. Dhirendra, thank you so much for spending time with us
this
week on Investors Guide. We look forward to having you back again soon. If you have questions for Dhirendra, write to us. Email ID is at the bottom of your screen. Coming up after the break, can NRIs take advantage of India's high interest rates? That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide on ET now. Let's bring in Gaurav Mashruwala to answer your questions on the show. Gaurav, thank you so much for joining us.
Thank you so much.
Our first question comes in from Anup. Anup is 27 years old and he lives and works in the UAE. He tells us he saves about 80,000 to 1 lakh Indian rupees every month. And he wants to buy property in India a year from now. But he wants to know if there's a place where he can invest this money, get good returns, and not have to be locked in. Gaurav, what would you recommend he does?
Anup, it's great that at such a young age you're thinking of investing and setting aside money and creating a corpus. Now, if 1 year is pertinent, which means you require money after 1 year for sure, then I would recommend you to choose a debt fund. Keep doing the systematic investment plan. Keep investing fixed amount that you are saying every month into it. At the end of the year, whatever is the corpus, take it out to use it, buy a property. Now, if there is some kind of flexibility, then I would say bring in some equity component. What you can do is choose a mutual fund scheme which is 10 to 20% equity and rest into debt. Equity component will give you certain kind of kicker, which means your returns could be slightly better. However, at the time of requirement of money, if markets are bad, then you may have to wait. When you invest into mutual fund as an NRI, you bring your money into NRE account preferably, and then invest so that at any point of time, after redemption, you don't take back that money. It's possible. So keep in mind that money gets routed through an NRE account.
Well, Anup is not alone. Chirag is another NRI who wants to invest 25,000 rupees a month in mutual funds for the next 7 to 15 years, and he wants to know which funds he should choose. Well, this is very interesting. He wants a high-risk, high-return investment with a minimum of 4.5% per year as return. What would you recommend he does with this money?
Chirag, here it is. If you're looking for an appreciation of growth, then you can't have security of principal. If you want security of principal, then you need to let go of your need for appreciation and growth. So NRE account will give you tax-free returns, but they'll give you a lesser return. That's why your principal is protected, it's intact. If you're looking at appreciation and growth, there are two asset classes that comes to my mind. One is equity and gold. What you can do is, as far as equity is concerned, since you have a long term, you can even look at mid and small cap funds. So fund that puts in mid cap and small cap companies, and portion of it can also be going in large cap fund and buy a gold fund. Now here there will be volatility. So what will happen is that your fund will keep going up or down depending on market conditions. Also, it could be that when you really require money, situations could be adverse, and hence you may have to wait for a couple of years. So you'll have to choose between the two. You can't have a situation whereby you are saying that I want safety of principal at the same time growth. I would suggest that since you have a long horizon, take that risk, live with that volatility, but go for equity and gold as an asset class and choose an appropriate mutual fund scheme.
Varshri is written, Gaurav, he will get an additional monthly income of 40,000 rupees right through this financial year, which obviously means he has got a raise. So congratulations, Varshri. He wants to accumulate this money, so to grow to about 5.5 lakh rupees at the end of April 2014. Gaurav, how can he make that happen given the high interest rates in all of our bank deposits right now?
So Varshri, here what you're talking about is investing 40,000 every month. So you are saying that in next 1 year you'll be able to invest up to 4,80,000, and you want that corpus to grow to 5.5 lakhs, which does not seem very difficult. What you can do is, depending on how immediate, how pertinent your requirement is at the end of 1 year. If it's really, really pertinent and you require that money exactly at the end of 1 year, I would say go for debt-based mutual fund. You would be able to accumulate say about 5.5 lakhs, maybe plus or minus 10,000-15,000. If it's flexible, then I would say go for a mutual fund scheme which is about 10 to 15% to equity and rest into debt. What will happen is there's a possibility of getting higher return. However, if the things are bad, then at that point of time you may not have exactly 5.5 lakhs. So if your goals are flexible, have a mutual fund which has some equity component. If your goal is not flexible, then choose a debt fund.
I have time for one last question. Ajit has written in, he wants to invest 20,000 rupees every month, and he wants to know where he should put this money. Obviously, Gaurav, he hasn't told us whether he's open to taking risk and what his time horizon is, but let's assume he's a long-term investor. Where would he put that money?
Ajit, you haven't said what you want to do, but you are younger and starting at very early age, which is really, really creditable. I'm assuming that this is for long-term, which means either for retirement or some other responsibilities which are going to happen. I would encourage you to take certain amount of risk and get into a riskier asset, which could be equity or gold. Mutual fund schemes that are there which puts into equity, gold. There are some schemes which is combination of two. Choose any one of these and keep investing in systematic manner. Set aside money on regular basis into this, and then as and when you require money, you can redeem part of it or completely and use it for the financial goal that you need to fulfill.
Gaurav, thank you so much for answering our questions on Investors Guide.
Thank you so much.
Remember, if you have questions for any of our experts, send them to us. There's an email ID at the bottom of your screen. Till next week, catch Investors Guide. Thanks for watching.